Hi everyone. In this video we'll discuss calculation of deferred tax assets and liabilities from the balance sheet perspective by looking at the differences between the book basis of an asset and the tax basis of an asset. An assumption underlying a balance sheet is that assets will be recovered, that means used or sold to produce cash, and liabilities will be settled, that means paid, usually with cash. Those assets and liabilities typically create taxable or deductible amounts in the future when they are recovered or settled. Before that occurs, there could be a temporary difference between the book value of the asset and liabilities in the balance sheet and their equivalent tax basis, which is an asset or liability original value for tax purposes reduced by any amounts included to date in the tax return. A difference between book value and tax basis, commonly called book tax difference, implies a future taxable or deductible amount. So we can use book tax differences to calculate deferred tax assets and liabilities. Let's look at the Watson Associates example that we discussed in prior videos from the balance sheet point of view. Watson Associates purchased $60,000 of equipment in early January 2021. Watson estimates that the equipment will have a useful life of 3 years, so it depreciates the equipment with straight-line depreciation, $20,000 of depreciation expense each year, 2021, 2022, and 2023. However, tax rules allow Watson to take the entire $60,000 deduction for the cost of the equipment on its 2021 tax return. Watson has a 25% tax rate and pre-tax accounting income of $100,000 in each of those years. In 2021, at the end of 2021, the asset's book value as reported in the financial statements is $40,000. That is equal to the asset's original cost of $60,000 minus depreciation taken in 2021 of $20,000. However, for tax purposes, the asset was fully depreciated in 2021, so its tax basis at the end of 2021 is zero. This creates a book tax difference of $40,000. The book tax difference implies that, in the future, Watson will have $40,000 less tax deduction for depreciation, so Watson's future taxable income will be higher by $40,000. Therefore, Watson should record a deferred tax liability of $40,000 times 25%, or $10,000. As shown in the table, Watson can use the asset's book-to-tax difference each year to calculate the related deferred tax liability. That's just another way to accomplish step 2 in our 4-step process. The income statement and the balance sheet perspectives are two complementary ways to accomplish the same objectives. Let's do a concept check problem for Hardy Welders. Hardy Welders, Inc. had purchased a machine at the beginning of year 1 for $2 million. The machine has a useful life of 10 years and a book value of $1,800,000 at the beginning of year 2. Hardy depreciates the machine on a straight-line basis for financial reporting purposes, but fully depreciates it on the date of purchase for tax purposes. Hardy pays taxes at a rate of 25%. Hardy's Year 2 balance sheet would include a deferred tax liability of what? Now remember that the book tax difference at the end of year 1 and at the beginning of year 2 is $1,800,000. You have not yet subtracted the book depreciation expense for year 2, and that will definitely affect your answer. So go ahead and calculate the deferred tax liability at the end of year 2 for Hardy. Did you calculate $400,000? Answer B. So this $1,800,000 includes the $200,000 of depreciation expense for year 1. There will be an additional $200,000 on the financial statements of depreciation expense for year 2, so the book value of the asset will be reduced to $1,600,000 at the end of year 2. $1,600,000 times 25% is $400,000 deferred tax liability. Well, that's all for this video. In our next video, we'll discuss revenue-related deferred tax liabilities. See you next time.